Hello, Bilal. How are you?
Assalamu alaikum. How are you?
I'm fine. How are you? How is everything? How's your place? How people?
Alhamdulillah. What about your country?
Hi, Zikriat.
Walaikum assalam.
How are you?
I'm fine, and you? Hi, teacher.
Assalamu alaikum.
But my network is a little bad.
Not able to continue the class or what?
And I don't know, but I try.
Alhamdulillah, السلامة. كيف؟ يقول والله جوز خلاص ما كنت في الشباب قاعدين فاكرنا شكرا واحد انا خلص سوا So I met someone, sorry for disturbing.
No issue. Can we start?
Yeah, shall we start? Zikriat, shall we start or not?
Yeah, I start. Inshallah, will be good.
If your network not good, can perform the class. See,
If you are going, that means my network is bad. But inshallah will be.
Inshallah,
you
we
go.
hope so. We hope so that the internet is to be better in your place, inshallah. Because Sudan, all the Sudan internet not good.
Yeah, the internet is good.
Okay.
Oh, shall continue.
Okay. So first of all, we have to start this chapter, I think. The CGT shares and securities for the individuals. We have to recognize the value of the quoted shares where they are disposed by a way of gift. Then we have to explain and apply the identification rule as they apply to individuals, including the same day and 30-day matching rules. Then pooling provisions we have to study. Then we have to explain the treatment of bonus issue, right issue, takeovers, and reorganizations. Exemption available for gilt-edged securities and qualifying corporate bonds. Shares and securities special rules. We have valuation of the quoted shares. We have identification rules. We have some share reorganization and takeovers. And we have special type of securities which are gilt-edged securities and qualifying corporate bonds. Then the basic chargeable gain computation is used as normal on a disposal of shares or security. Okay, the chargeable gain computation will be as normal, but however, because shares in the same company are indistinguishable from each other, they are special rule to identify the allowable cost. So we have same scenario will be used for the shares to compute the gain, but we will look at, we have to calculate the cost of the shares. Government securities and qualifying corporate bonds. All shares and securities disposed of by an individual are subject to capital gain tax except for the following, which are exempt. Okay, all shares and securities are exempt except these listed government securities. These are exempt. Qualifying corporate bonds and the share held in CISA, individual saving account. These are exempt. Then we have to definition of the qualifying corporate bond. Qualifying corporate bond represents a normal commercial loan. Okay, qualifying corporate bonds is like a normal commercial loan and will be expressed in sterling and has no provision for either conversion into or redemption in on any other currency. Okay, it will be in pounds only and should be issued after 13 March 1984 or was acquired by disposer after the date whenever it was issued. Okay, you must have the bonds after 1984, not before that. Then valuation of the quoted shares. How we will value the quoted shares? On a sale of shares between unconnected parties, the actual proceeds are used in the capital gains computation. Okay. on the sale of shares between unconnected parties, the actual proceeds are used in the capital gains computation. Okay, when they are unconnected parties, so the sale proceeds will be used to compute the gain. However, it will be necessary to identify the market value of the quoted shares. Okay, if they are gifted, so we will take the market value of the shares, or if there is a transfer between the connecting party, your brother, your sister, whatever, so we'll take the market value of the share. For capital gain tax purpose, the market value is determined by the mid price average of the price quoted in the stock exchange daily official list on the disposal date. Okay, the shares in Panda PLC are quoted in the stock exchange daily official list at 230 pence and 270 pence. If a disposal of Panda PLC shares were made on that day to a connected party, what would their value be for CGT purpose? Value of Panda PLC share is 250. 270 plus 230 multiplied by half. So it's 250. We'll take out the average price. Okay. When you don't have a market value, when you don't have the sale proceeds for the sale of the shares, they may be gifted or may be transferred to a connected party. Then we have some identification rules. It is necessary to identify or match rules to determine which shares have been disposed of. Okay, shares and securities that are bought in a particular company of the same class are not distinguishable from one another. Each time shares are bought in any quoted company, the price paid may be different. They enable you to decide which shares have been sold and to work out the allowable cost to use in the capital gain computation. Okay, when you are buying shares, you buy one time, second time, third time, every time the price is different. So when you have a stock of shares, then you are selling some of the shares. So how you will sell them? On FIFO basis, on LIFO basis, or whatever. Okay, so this is the problem for selecting the sale proceeds. Then identification rules for disposal by individuals. When shares are disposed of, they are matched against the shares acquired of the same class in the following order. On the same day as the date of disposal, within the following 30 days from the share pool, shares acquired before the dates are pooled together. Okay, if you have bought it on the same day and you have disposed it, so it means these are the shares which you have disposed, or you have bought in before 30 days. So that shares will be disposed of. You don't have to identify it. Just think that when they were bought, shares acquired within the following 30 days. It may appear strange that a disposal is matched with the acquisition following the date of this sale. The reason for this is to counter a practice known as bed and breakfasting. Okay, there is a reason for this rule, which is called bed and breakfasting. Without this 30-day matching rule, shares could be sold at the close of business one day and bought back at the opening of the business the next day. A gain or loss would be established without making a genuine disposal of the shares. Okay, if that would be not the rule, so share could be sold at the close of one business day and bought back at the opening of the business in the next day. Gain would be there or loss would be there, so it will not be a genuine disposal of shares. So to avoid this bad practice, they have made this rule. This was useful for an individual to establish a capital loss. Okay, he will say, I have bought these shares, sold these shares at a loss, so he will claim the loss. Or he can put a gain to use the annual exempt allowance if it had not been used already. Okay, so the 30-day matching rule makes the practice of bed and breakfasting much more difficult, since the subsequent reacquisition of shares cannot take place within the 30 days. since the subsequent reacquisition of shares cannot take place within 30 days. Okay. Now, this is the example for it. There's a Frederick had the following transactions. Zakaria, you can hear me now?
Yeah.
Okay.
I hear you.
Nazar, you can also hear me.
Yeah, I hear you. I hear you.
Okay, good.
You listen to me?
I am listening to you. Yes.
For I read.
Yes, I can hear you, but there was disturbance in your voice. You can speak again what you are saying.
You think me for read or what?
No, you hear me? هل تسمعوا؟
Yeah, I hear you.
Okay.
Okay. Continue, George.
Okay. 1 minute. Okay. Now, Frederick had the following transactions in the shares of Mentley PLC, a quoted company. He bought 4,000 shares for 8,000, then bought 1,800 shares for 9,750, 500 shares for 4,000, 1,000 for 8,500, 3,500, 36,800 for 6,400. From 1st June 2024 to 28 March 23. Identify with which acquisitions the shares sold on 15 March 23 will be matched. He has sold the shares on 15 March 23. Okay. Shares sold are identify which acquisition with which acquisition the shares sold on 15 March 23 will be matched. Number of shares sold is 3,500. Shares acquired on same day is 0. Okay. And shares acquired on following 30 days is 28 March 23. 800. Okay. So the balance is 2,700. Then shares pre 15 March 23. Okay. There was sold shares was 3,500 on 15 March. So following 30 days are 800. Left is 2,700. Now we look at the on the same day following 30 days. Then from the share pool, share acquired before the date of disposal are pooled together. Then they are all pooled together. So 1st June, 30 July, 30 April, 13. Then these are all 7,300. Okay, these are all pooled together. The disposal from the share pool is therefore 2,700 out of 7,300. So it's 0. Okay, this will be the criteria for selling the shares. What we'll do first, we'll look at the date when the shares are sold. Then we look at the 30 days following that share, after that share is purchased, after that share is sold. So it's 28 March, first 800 shares. Then we go back. We'll make a share pool. We'll combine all the shares together. Then balance of the shares will be sold from this pool. Okay. Then we have explanation for the share pool. For an individual, the share pool contains shares in the same company of the same class purchased before the date of disposal. The share pool simply keeps a record of the number of shares acquired and sold and the cost of those shares. When shares are disposed of out of the share pool, the appropriate proportion of the cost which relates to the shares are disposed of is calculated. Okay. Thus, if there are 6,000 shares in the pool with a cost of 8,000 and 2,000 are disposed of, so 2,000 divided by 6,000 multiply by the 8,000. So this will be the cost of the share removed. That is 2,667. Okay. So when the shares are disposed of, we'll take out the pool. If there are 6,000 shares in the pool and the cost is 8,000 and 2,000 shares are disposed of. So 2,000 divided by 6,000, this is a proportion of the sale, proportion of the disposal, multiply by its cost, that is 8,000. Okay. Then we have to calculate the gain and loss on the disposal of the shares. How we'll calculate? Once the identification rules have been used to identify which shares have been disposed of, the cost of these shares is used. These cost of these shares are used in the normal chargeable gain computation. Now we have again the example. Frankie sold 11,000 ordinary shares in Hastings Company PLC, a quoted company, on 18 December 22 for 50,000. It has sold 11,000 shares on 18 December for 50,000. They had bought ordinary shares in the company on the following dates. Okay, the number of shares bought now: 6 April 2006, 8,000, 7,450, 12 December 2014, 4,000, 5,500, 10 January 2000, 6,000. We have to calculate the chargeable gain arising on the disposal of the shares. Okay. Now, capital gain computation. We have to identify the shares which are disposed of. So the shares were disposed on 18 December 22. And when we add 30 days, we have a purchase of 2,000 shares on this date, 10 January. So same day 0, acquired in April, acquired in following 30 days is 2,000. We have left 9,000. Okay, and share pool is now 12,000, combining these two, and we have sold 9,000 out of it. So 0, 2,000 from this and 9,000 from this. Okay. Now we have to calculate the chargeable gain. First is the sale proceeds. 2,000 divided by 11,000 multiply by 50,000. 2,000 is your these shares. Shares sold is 11,000 multiplied by the 50,000. So it's 9,091. This is the sale proceeds. Okay. Less the acquisition cost. Acquisition cost was 6,000 of this 2,000 shares. Okay. So chargeable gain is 3091 from shares acquired on 10 January. Then share in the same pool, that is 9,000 divided by 11,000 multiplied by 50,000, sale proceeds is 40,000. Acquisition cost will be 8,000, 4,000 is 7,450 and 5,500. 12,950 is your cost of these 12,000 shares. And when we dispose of 9,000 divided by 12,000, multiply by 12,950. The number of shares is obviously 9,000 and the cost is 9,713. Okay.
Okay.
Balance carried forward is 3,000 which are left and the value is 3,237. The average cost method is used to calculate the cost removed from the share pool on the disposal, which we already discussed. Okay, so total chargeable gain would be 40,000 minus 9,713 is the acquisition cost. Chargeable gain is 31,000 and total chargeable gain is 31 plus 309. It's 34,287. Okay.
Okay.
Zakaria, you are with us.
Yeah. Okay.
Then we have bonus issue. One second, please. 1 second. Okay, now we have bonus issues and right issues. A bonus issue is the distribution of free shares to the shareholders based on their existing shareholding. We know this. Okay. We offer 1 for 4, 1 for 3. Who has 3 shares, he will get 1 bonus share free of cost. Okay. Why we do this? To increase our share capital. The number of shares only, not the amount. Okay. For capital gain tax purpose, they are treated as follows. For the purpose of the share identification rules, the bonus shares acquired are included in the share pool at nil cost. Okay. Bonus shares will be added in the cost at nil cost. And the bonus shares are not treated as a separate holding of shares. Okay. Like this, an example, Blackburn had the following transaction: the shares of Gray purchased 3,500 shares, then 500, then bonus issue of 1 for 5, then sold 2,600. Okay. Sale proceeds are 10,500, 400, less cost. Cost is how much he has sold? 2,600. There is no purchase after that date in September 22. So we'll take out from the pool. So purchase is 3,500. Okay. Then 500. Cost is 7,350, 1,750. Total is 4,000. Cost is 9,100. We have bonus issue 1:5. Okay. So 4,000 divided by 5. So it's 800. So 4,800 number of shares have increased, but the cost have not increased because it's a bonus issue. Then we have a sale, 2,600 divided by 4,800 total number of shares, multiply by 9,100 the cost. So it's 4,929. So balance carried forward is 4,171 and 2,200. Okay.
Okay.
This was the example for the bonus share. When bonus shares are issued, so number of shares will increase, but the cost will not increase. Now we have a right issue. Right issue is the offer of new shares to the existing shareholders only. These are also offered to the existing shareholders, but it's for a price, not for free. These are not bonus shares. Okay. Then right issue are similar in concept. Okay. Right issue is the offer of new shares to existing shareholders only in proportion to the existing shareholding, usually at a price below the current market price. Okay, they are offered below the current market price, because obviously if there is at market price, they will buy from market, not from you. Right issues are similar in concept to bonus issues. However, because money is paid for the new shares, there are additional factors to consider. As for bonus issues, the purpose of the share identification rules, the right share acquired are included in the share pool. They are also included in the share pool. For the purpose of tax, the number and the cost of shares are included in the pool in the same way as a normal purchase. Okay, for the purpose of tax, the number and the cost of shares are included in the pool in the same way as a normal purchase. Okay. Now we have the example for it. Calm Chill had the following transactions. He purchased 2,700 shares, then 600, then took up 143 right issue at 2.3, then sold 4,000. Sales proceeds is 14,000. Cost we have calculated here. We have 2,700. Then we have purchased 600. Cost is this. Then the right issue at 2.3 per share. 143. It means 1,100 share would be issued. Okay. And the cost would be 1,100 multiplied by 2.30. Okay. So 2,530 would be the cost. So shares have increased by 4,400, then 9,430. Then we have to sell. So 4,000 divided by 4,400 multiplied by 9,430. So 8,573 is the cost. Carried forward is this balance. Okay.
Okay.
Now we have some reorganizations and takeovers. Okay, a reorganization involves the exchange of existing shares in a company for other shares of another class in the same company. We are exchanging the shares in a company for other shares of another class in the same company. Okay. The takeover occurs when one company acquires the shares in another company, either in the exchange of shares in itself, cash, or a mixture of both. Takeover, we know, when I'm buying a company, I buy its shares. I can pay cash for it, or I can pay my shares for it, whatever. This is called takeover. In reorganization, we are only exchanging shares. And when we are talking about takeover, we are buying it by giving cash or by giving shares itself. Now, consideration, when we talk about shares for shares, where the consideration for the reorganization or takeover only involves the issue of shares in the acquiring company, the tax consequences are when you are giving shares for shares, whether it is reorganization or takeover. No CGT will be charged at time of reorganization takeover. The cost of the original shares become the cost of the new shares. The cost of the original shares becomes the cost of the new shares. Then, where the shareholder receives more than one type of share in exchange of for the original shares, the cost of the original shares allocated to the new shares by reference to the market value of the various new shares on the first day of dealing in them. The treatment is automatic. Where the shareholder receives more than one type of share in exchange for the original shares, the cost of the original share is allocated to the new shares by reference to the market value of the various new shares on the first day of dealing in them. You look at the example, it will be more clear. Emina purchased 2,000 ordinary shares in Blue PLC for 5,000 in June 2010. In July 2017, after 7 years, Blue PLC underwent an reorganization and Amina received two A-class ordinary shares in exchange of each of her ordinary shares. Amina first purchased 2,000 ordinary shares in Blue PLC. Then in July, Blue PLC underwent an organization. Amina received 2 ordinary shares in exchange for each of her ordinary share. Okay. In December 22, Amina sold all of her holding of A ordinary shares for 8,000. You have to calculate the chargeable gain. Sale proceeds of course 8,000. The cost of the original ordinary shares 5,000 becomes the cost of the new ordinary shares. Okay. So Amina purchased 2,000 ordinary shares in Blue PLC for 5,000 in 10. So 5,000 became the cost again when he sold in 22. Okay. When there is reorganization and there is no cash involved, only shares are exchanged. Okay. Then again, there is an example. In July 22, Craig sold his entire holding of ordinary shares in Chorus PLC for 75,000. Craig had originally purchased $20,000 ordinary shares in BNB PLC at a cost of 20,000 in April 2009. Okay, in July 22, Craig sold his entire holding of shares in Chorus PLC for 75,000. He originally purchased 20,000 ordinary shares in BNB PLC at a cost of 20,000 April 2009. In July 22, BNB Place PLC was taken over by Chorus. Craig received 1 ordinary share, 50 pence shares, and 150 pence 6% preference shares in Chorus PLC for each ordinary share he held in BNB PLC. Immediately after the takeover, the values of these new shares were quoted as 1.8 and 0.8 each for ordinary shares and preference shares. We have to compute the chargeable gain. Sale proceeds is 75,000. Okay. Then the allocated acquisition cost. Following the takeover in July 2012 of BNB PLC by Chorus, Craig now owns the following shares in Chorus as per the terms of takeover. Total market value of 20,000, 50 pence ordinary shares at 1.8, that is 36,000. Market value and original cost was 13,000. And 20,000, 50 pence preference shares at 0.8, that is 60,000, 16,000. Original cost was 6,154. Total market value at current market rate is 52,000. Original cost is 20,000. We have to allocate the original cost incurred in April 2008 to the shares now owned in July 2011 using the normal average cost method. 36,000 divided by 52,000 multiplied by 20,000. The value is 13,856, 846, and 6,154. Is calculated how? 16,000 divided by 52,000. It's 20,000. So 6,154 is the original cost. We have calculated. Okay.
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 Hey. Then we have some takeovers and considerations where there is consideration in cash or shares. First, we are talking about the only shares are exchanged with the shares. Now, if the consideration for the takeover includes a cash element, then there's a part disposal of the original shares. A gain arises on the cash element of the consideration on the date of the cash is received. If the consideration for the takeover includes a cash element, there's a part disposal of the original shares, and there is a gain on which arises on the cash element of the consideration on the date of the cash is received. In these circumstances, the part of the cost of the original holding apportioned to the cash is calculated as cash received divided by cash received plus market value of the new shares multiplied by the cost of the original shares. Cash received divided by cash plus market value multiplied by the cost of original shares. Now, Patrick bought 10,000 shares in Target PLC in May 2012 for 20,000. He bought 10,000 shares for 20,000. Then on 3rd November 22, the entire share capital of Target PLC was acquired by Bidder PLC. The entire share capital was bought by Bidder PLC. The Target PLC shareholder received 2 Bidder PLC shares and 0.5 cash for each share held. Target PLC shareholder received 2 Bidder PLC shares for 1 share and 0.5 cash for each share held. Bidder PLC shares were quoted at 1.25. Now the total consideration provided 10,000 multiplied by 2 multiplied by 1.25. This is the value of the shares received by the Target PLC, because Bidder PLC shares were quoted at 1.25 and he was getting 2 shares for every 1 share sold. So 10,000 were the shares multiplied by 2 multiplied by 1.25. So 25,000 is the market value. Then cash received is 10,000 multiplied by 1 multiplied by 0.5. He's getting 0.5 pounds cash for every 1 share. So 5,000 is the market value. So this market value is 30,000, and we have calculated the cost as well. As Patrick has received part of the consideration in cash and he has made a part disposal of the original shares. So disposal proceeds is 5,000. Deem cost 5,000 divided by 30,000 multiplied by 20,000. The cost. Yeah. So it's 3,333. Chargeable gain is 1,667. Patrick allowable cost of the future disposal of his shares is 16,667 for the future disposal. Now the chargeable gain is 1,667. Okay. Okay. Can I move forward?
Yes, almost.
The meeting, we have to renew the meeting because it will end in 1 minute.